You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings. It is January 14th, 2026. Today we are looking at the behemoth that is Bank of America fourth quarter results. And honestly, Miro, looking at this report, it feels like the engine is running perfectly on one side of the car and the wheels fell off on the other.
That's actually a pretty accurate visual. Yeah, headline numbers came in mixed. Earnings per share hit 98 cents, down from $1.04 in Q3. Revenue dipped to $28.4 billion, also down from $29 flat last quarter. The market clearly wanted more consistency. We saw the stock gap down this morning, sold off pretty hard, and stabilized around 52.20. So down almost 3% from where it was before the call started.
Ouch. So the market sees a red flag. But wait, wasn't the big narrative supposed to be the NII pivot? Like the net interest income bottoming out? I thought that was the golden ticket for banks right now.
It is. And that's the irony here. The core banking business, taking deposits, making loans, actually did exactly what they promised. Net interest income went up $500 million to $15.9 billion. That trough everyone was scared of, it's in the rearview mirror. But then you look at the trading desk, global markets revenue dropped 15%. Just evaporated relative to Q3.
15%? That feels like more than just seasonal noise. That's a real air pocket. And just to be clear for everyone listening, none of this is financial advice, just two friends nerding out over bank balance sheets. But seriously, Miro, is that trading drop a B of A problem, or is the market just erratic?
That's the $6 million question, or I guess in this case, the $1 billion question. Management is calling it seasonal, but when you see fixed income and commodities drag that much, you have to wonder if they missed the boat on some volatility. Meanwhile, Moynihan is out there talking about a soft landing like it's already a done deal.
He sounded confident, didn't he? Basically saying the consumer is fine, credit is fine, spending is up. It's almost a disconnect from the stock reaction. The business says growth, the traders say risk.
Always. The bond market is scared of shadows, and the bank CEO is looking at credit card swipes saying everyone's buying groceries. There's a tension in this report. The boring stuff, loans, deposits, is working. The exciting stuff, trading, is failing.
Boring is good until you need growth, I guess. All right, let's dig into what those numbers actually mean.
Right, and if you dig into that boring engine, the net interest income, which is basically the bank's paycheck, came in at $15.9 billion. That's up $500 million from the third quarter. So the thesis held up. The old cheap loans are rolling off. New higher rate loans are coming on. And that repricing is finally outpacing the Fed cuts.
Which is huge because for the last year, everyone was terrified of cash sorting. You know, people moving money from zero interest checking to 5% CDs. But listening to Moynihan, it sounds like that bleeding has stopped.
Stopped and reversed. They actually grew average deposits by $17 billion this quarter. And loans grew 8% year over year, which is faster than the industry average. So they aren't shrinking to safety. They're actually taking market share.
Okay, but let's talk about the cost of doing all that business, because usually when you grow loans like that, expenses creep up.
That's the clean part of the report. Non-interest expense was $17.4 billion, basically flat, up just 1%. And here's the stat that blew my mind. They hired 17,000 people last year. Yet their total headcount ended the year flat.
Wait, how does that math work?
Attrition matches hiring, but the volume of work went up. Moynihan explicitly said they're using AI to cover the gap. Get this, active mobile users hit 41 million, but interactions with Erica, their chatbot, actually dropped.
Dropped? That sounds bad. Like people got annoyed and hung up?
No, that's the trick. They're saying the AI is getting proactive. It sends you an alert before you need to ask a question. So fewer questions, same customer satisfaction, zero extra headcount. That's pure operating leverage.
Okay, that is some Minority Report banking right there. Fixing my problem before I know I have one. But what about the scary stuff, the credit risk? We keep hearing about commercial real estate imploding.
Yeah, the famous doom loop. Well, it didn't show up here. Net charge-offs actually declined to $1.3 billion. And specifically, losses on office loans dropped. So if there is a crisis, Bank of America seems to have it fenced off.
That is surprisingly optimistic. So net interest income is up, credit costs are down, expenses are flat. The only ugly mark is that trading desk dropping to $5.3 billion.
Which, to be fair, is volatile by design. But wealth management, the WGIM division, picked up the slack. They brought in $20 billion of new client flows. Record margins there. It's becoming the ballast against the trading volatility.
So a split personality quarter, but the foundation is solid. That's the P&L snapshot. But there's something else in the fine print. Something about a retrospective accounting change that management slipped in, which makes the capital ratios look a little different.
Yes, the tax equity maneuver. I was hoping you cut that.
Oh, I got it. And I think we need to talk about what it actually does to the numbers.
It's a classic corporate sleight of hand. Look, historically, Bank of America invests in things like affordable housing or solar projects. They get tax credits for that. Usually, those credits show up at the bottom of the P&L, lowering their tax bill. Boring, right?
Right. It's just saving on taxes.
Well, this quarter, they decided to change the accounting method retrospectively. Now, instead of just lowering the tax line, those credits are being used to offset the investment expense in the other income line.
Okay, wait, so they moved the benefit from the bottom of the page to the top of the page.
Exactly. It doesn't change the net income. The cash in the bank is the same, but it boosts revenue and lowers expenses relative to the old method. It aligns them with peers, fair enough, but it also knocked 12 basis points off their CET1 capital ratio. So they effectively paid a little bit of capital safety to make the income statement look prettier.
That is incredibly cynical. I love it. But, okay, that's the accounting nerdery. Was there anything in the strategy that felt real?
Yeah, and this is the part that actually worries me. Moynihan went on a bit of a rant about the Genius Act, his words, regarding stablecoins and private money.
Oh, I saw a headline about that. He was warning about deposits leaving the banking system, right?
It's deeper than that. He's making a structural argument about how the economy functions. His point is, if people move their money into stablecoins or money market funds, that money sits in treasuries. It funds the government debt.
Okay.
But when money sits in a bank deposit, the bank leverages it to lend to a local bakery or a construction company or a homeowner. Moynihan's warning is that if you let $6 trillion migrate out of the banking system into these digital wallets, you're effectively stripping the funding source for small business America.
That's actually a heavy point. He's saying stablecoins aren't just new tech, they're a liquidity drain on the real economy.
Exactly. He thinks it forces banks to go out and get wholesale funding, which is expensive, instead of using cheap deposits. If banks have to pay more for money, they charge more for loans. So the irony is that these efficient new crypto dollars might actually make a car loan more expensive for a regular guy in Ohio.
Wow. So it's not just a turf war. I mean, obviously he wants to keep the deposit, so he's talking his book, but you think he has a point?
I think he's identifying a feedback loop that regulators haven't priced in. It's easy to say banks are dinosaurs, but dinosaurs are big enough to carry a lot of weight. If you starve them of deposits, they stop lending, and stablecoins don't do small business loans. They just buy T-bills.
So we're trading lending capacity for, what, digital convenience?
Pretty much. And for a bank that just proved it can navigate a high-rate environment, the biggest threat isn't the recession anymore. It's the plumbing of the financial system getting rerouted around them.
That is a wild angle. It frames B of A not just as a business, but as this utility that we might be breaking without realizing it.
And that's why I listen to the calls. You come for the earnings per share, you stay for the existential crisis about the nature of money.
Only you, Miro. Only you. Okay, so yeah, let's step back for a second. We've got the accounting tricks, the stablecoin warning and this soft landing optimism. What does all this mean for them heading into 2026?
It means they think the hard part is over. If you look at the guidance, they're projecting net interest income to jump roughly 7% year over year, starting in Q1. They're also targeting 200 basis points of operating leverage for 2026. Basically, they expect revenue to grow significantly faster than expenses.
So they're doubling down on the no landing thesis. The economy doesn't break, consumers keep spending, and B of A just rides the yield curve back up.
That's the bet, but it's not risk-free. They admitted that if rates fall faster than expected, say the Fed cuts an extra 100 basis points, that knocks $2 billion off their NII. So they need a Goldilocks economy, not too hot to spike credit costs, but not so cold that rates collapse.
Right. They need the boring middle, which feels optimistic given how weird the world is right now. And frankly, they need that trading desk to stop bleeding. You can't have global markets down 15% every quarter and expect the checking accounts to carry the whole load forever.
True. Though I suspect the traders will tell you this quarter was an anomaly. But you're right, it feels like a steady-as-she-goes report, but with a few warning lights blinking on the dashboard that they're trying to ignore.
Steady, but fragile. But hey, for a bank this size, boring is usually profitable. I think we've squeezed all the juice out of this one.
I think so. The spreadsheet is closed.
All right, then. Let's close this out.
Right. That's the quarter wrapped.
It is. And before we go, I want to take a quick moment to pull the curtain a bit behind. Earnings Unscripted is an experiment. It's a project by a small team of enthusiasts exploring the frontier of AI and how it can be used to actually enrich us rather than just distract us. Everything you heard today was created by a chain of AI agents working together. We have a research analyst agent parsing the raw 10 Qs, a scriptwriter crafting the narrative, a QA specialist checking the facts, and finally us, the hosts, bringing it to life. The goal is to see if we can deliver high-quality, up-to-the-minute financial analysis that feels, well, human. We are still learning how to get this right, so we'd honestly love to hear what you think. If you have questions, comments, or just want to tell us we missed a nuance, reach out to Earnings Unscripted at datamadness.ca or follow us on X. Thanks for listening to The Experiment.
Right. That's the quarter wrapped.
It is. And before we go, I want to take a quick moment to pull the curtain a bit behind. Earnings Unscripted in this financial sky. This is an experiment by a small team of enthusiasts exploring the frontier of AI and how it can be used to actually enrich us rather than just distract us. Everything you heard today was created by a chain of AI agents working together. We have a research analyst, agent parsing the raw 10 Qs, a scriptwriter crafting the narrative, a QA specialist checking the facts, and finally these hosts here bringing it to life. The goal is to see if we can deliver high-quality, up-to-the-minute financial analysis that feels human. We are still learning how to get this right, so we'd love to hear what you think. If you have questions, comments, or just want to tell us we missed a nuance, reach out to Earnings Unscripted at datamadness.ca or follow us on X. Thanks for listening to The Experiment.
Right. Well, that was the quarter wrapped.